This video is about whether you should make the jump to a new fixed rate that's available right now before your mortgage cliff is about to expire on your ass. So to go to the drawing board right now, your situation is you're on a 1.99/2.99 fixed rate. This is your ass, and this is the mortgage cliff, and this is where your fixed rate will expire, somewhere in, for example, July, August, or September. And if you decide to do nothing, well, your ass will go on this trajectory and then fall off the mortgage cliff. And underneath is sharks, which is a sign for debt collectors. And then sitting on the sharks is Philip Lowe with the Satan's trident. And since now is June, there'll be July, then August and September. Well, his magical devil's trident will roast your ass with a 7.5 to 8.5 variable rate when your ass comes off the mortgage cliff. And right now, I'm going to draw a table to show you whether you should fix a new rate right now, break your current 1.99 or 2.99 fixed rate, and whether that is beneficial for you. So let's hypothetically put some numbers so that you can make sense. For example, you have a $1 million property which is valued today, and your home is $600K. At 199%, which is the fixed rate you've got on about 2 or 3 years ago, which is expiring soon, at $600K is $2,214.72. Now, if you're like the 85% of people who usually don't shop around and you just do JS, which is jack shit, well, your ass will roll over to the mortgage cliff and probably get a 7% interest rate when the bank and Mr. Philip Rowe roasts your ass with another 2 or 3 more rate rises. So at 7% hypothetically, at $600K home loan, your repayment on principal interest will be $3,991.81, which means you'll be paying an extra $1,777.09. 777, lucky number. Now, say you're not such a jackass and you're actually a smartass, so let's put some glasses over your ass. And you decided to not let the bloody mortgage cliff kill you, so you decide to extend the mortgage cliff by breaking this rate and going on another fixed rate right now. Which, if you decide to lock in the rate right now for IMMB, it will be 5.24, Bank of China 5.29. And if you don't like Chinese communist banks, Adelaide Bank is doing it at 5.39. And those are 3-year fixed rates. And by the way, with Adelaide Bank, you can have an offset account against a fixed product, dollar for dollar. Wow. So if I punch the numbers in at 5.39 at 600K, the repayment will be $3,365.44. Now compare that to a 7% interest rate, which is paying this. You actually save by the difference of this is $626.37 per month. So to make sense of this exercise, let's work out the opportunity cost, OC over here. So you get the rate you're paying at 1.99 repayment of this much minus the repayment at 5.39. So the opportunity cost is $1,150.72. So let's look at your ass on this mortgage cliff before it expires. So basically 1, 2, 3 months before your rate expires, you'll be paying an extra $1,150.70 opportunity cost to secure this rate for 3 years at this repayment, where you'll be saving $626.37 per month as opposed to being on the mortgage cliff rate by extending your fixed rate and your mortgage cliff further for another 3 years, not on 1.99, but an extension at 5.39 for another 3 years to avoid the bloody mortgage cliff, a variable or fixed rate, potentially of 7.5 to 8.5%. Now, I've been doing this strategy for a lot of clients that have been contacting me through TikTok because they have the mortgage cliff coming, and I'm calling this strategy the up your ass Philip Lowe strategy. And on top of this UYAPLS strategy, which I call your up your ass Philip Lowe strategy, I'll be applying the capture the leaking gold strategy as well. And what the capture the leaking gold strategy is while you have noticed that the interest rates have been going up, you would have noticed your property value going down. This is due to a correction in the market at the moment. So the longer that you do nothing by being a simple jackass like the major population, well, what happens is as the rates go up, the property value of your property goes down, which means for this example, this person's property is worth 1 million now, captured at the valuation point today. We'll plot 1 million over here. The bank will allow you to refinance up to 800K, which is 80% of this value, which is 800K. The capture the leaking gold strategy is basically your existing home loan is 600K. The difference is 200K. So you captured the leaking gold, which is at 200K, and put that in an interest-only offset. And while this is in an offset account, you don't pay jack shit because it's offset dollar for dollar. If you do not do the capture the leaking goal strategy, well, say 3 or 6 months later, your property won't be valued at $1 million. It might be valued at $800K. And at that point, your lazy ass goes, oh, well, I should have listened to Q, refinance, do all these strategies and, capture the leaking goal. Well, too bad how sad your property is not worth $1 million anymore. The correction has gone downwards. Now it's worth $800K. And the bank will value at 80% of $800K, which is $640K. Get that minus your existing loan amount of $600K. You've only got $40K equity cash out. While some of your mates who've done it before that would have got $200K, you sucked in and got $40K. So not only right now you got a shitty rate because you lost the 5.39 that you could have got it right now, you probably got on like 6.39 or whatever, and now you got less equity, which means you don't have any bullets to fire when there's blood on the streets, when people are off the mortgage cliff, they haven't done anything, they have to sell their property, properties are so low, but you don't have any bullets to fire because you have none of the equity pulled out prior to when you're supposed to do it when you're listening to this video. Again, not financial advice, but if you're smart, it is kind of like financial advice. No, seriously, not financial advice, but obviously a lot of people will call me and go, hey, I want to apply that strategy, and I do it for them, and it gets done, and they're super happy. So for the 50 to 80 people that have contacted me in the last 2 months that have applied this strategy, haha, we have captured the leaking gold, extended your ass for a little bit longer period, because I know that you can't escape the mortgage cliff, but you can extend it, protect yourself. Let's ride out the uncertainty in the economy. I think 3 years or 2 to 3 years is right enough for the fixed rate before the economy starts to correct itself and the rates start to go down. But at that time, you're protected. And this Mr. Mofo feel low with the shark over here can't get your ass. So guys, jump in the comments, either roast me or toast me. Let me know what you think.